Silver hit 92.40 on Tuesday morning. By Thursday close, it was trading 87.60. That's a $4.80 move. 72 hours, no macro catalyst, no Fed announcement, no demand shock, just price. Collapsing through levels that took weeks to build. And the mechanism behind that move is exactly what we're breaking down today. OG John XX. Copycats running the same format, same titles, same thumbnails. I sell nothing. No courses, no premium signals, no paid groups. OG John XX on YouTube. That's the only place. Data goes up when it breaks. Analysis stays free. No exceptions. And for the new people just finding this channel, those silver analysts charging $97 a month for insider alerts are watching these videos and repackaging what you're seeing here for free. That's not speculation. That's documented behavior. If this is sharpening your understanding of how these markets actually work, drop OG John XX below. I want to know who's in the room. Now let's get into what actually happened and why the data tells a completely different story than the official narrative. CME Group reported a, quote, technical glitch on Tuesday that affected silver futures order routing for approximately 40 minutes between 10:20 and 11 Central Time. Official statement cited infrastructure maintenance as the contributing factor. What they didn't address is why silver was trading 92.40 immediately before that window and 89.10 immediately after. A $3.30 move inside a 40-minute freeze where no retail participant could react, adjust, or exit. Only participants with direct market access and pre-positioned orders already acknowledged in the system could operate during that window. Everyone else was locked out, watching price move against them, with no ability to respond. That asymmetry is not accidental. That asymmetry is the point. Here's what makes the timing impossible to dismiss as coincidence. Silver had been building a compression pattern for 11 consecutive sessions. Price consolidating between 89.50 and 91.80. Tightening. Volume declining on down days, expanding on up days. Classic accumulation signature. The technical setup was pointing directly at 93.50 as the next major resistance. And above that, open air to 97. Any trader reading that chart knew what a break above 92 meant. It meant the next wave was starting. The halt happened at 92.40. 40 minutes later, 89.10. The compression pattern destroyed. The momentum reset. The breakout aborted. Funny how infrastructure failures only occur when silver is pressing into levels that would force short covering. Now here's the data that doesn't make headlines. COMEX registered silver inventory declined 3.1 million ounces across the same 3-day window. Single largest 3-day withdrawal we've tracked this year. Here's the breakdown. 820,000 ounces out of JP Morgan, 640,000 out of HSBC, 490,000 out of Brinks, 380,000 out of CNT. Small adjustments at Malka Amit and Loomis, but net outflow from registered was 3.1 million ounces in 72 hours. Metal is leaving the system faster than it's being replaced. Eligible inventory remains static. It's sitting there, but it is not being moved into registered. That distinction matters because eligible metal is not available for delivery until the owner designates it. What's available for delivery right now is registered, and registered keeps falling. Shanghai tells a completely different story. Shanghai spot currently trading 104. SHFE futures 108. Western spot 87.60. That's a $16.40 premium on physical spot. $20.40 if you compare Shanghai futures to Western paper. That gap is not arbitrage. Arbitrage closes. This gap is persisting and widening across consecutive sessions because the underlying physical demand in Asia is real, and the Western paper price is being managed. When those two realities exist simultaneously for this long, something eventually breaks. History shows us which one breaks first. Here's what most people tracking this story are missing entirely. Open interest in COMEX silver futures dropped 18,400 contracts in the last 5 sessions. That's 92 million ounces of paper silver, leaving the futures market. Simultaneously, SLV recorded inflows of 9.2 million ounces across the same window. Money is rotating out of futures and into physically backed ETFs. That rotation has one meaning. Participants who understand how COMEX delivery actually works are moving away from a market where delivery risk is rising. You don't pay ETF premium over futures unless you're concerned about what happens when you try to actually take the metal. That concern is showing up in the data before it shows up in the price. There are also 6,200 April contracts still open, with first notice day approaching. That's 31 million ounces. COMEX registered holds 83.2 million ounces total. The math is not complicated. If a meaningful percentage of those April contracts stand for delivery, the available registered inventory gets tested in a very serious way. Not theoretical, actual contractual obligations against actual physical metal that has to be there. Now, let's examine both explanations honestly, because dismissing the manipulation thesis without examining the evidence is exactly the kind of lazy thinking that keeps retail traders on the wrong side of these moves. Scenario 1. Genuine technical failure. Exchanges run complex systems. Outages happen. The 40-minute window, while suspicious in timing, could reflect legitimate infrastructure issues. Price drop after reopening explained by stop-loss cascade, and leverage liquidation from participants who had resting orders below market. Order book reset during the halt created vacuum conditions when trading resumed. Selling pressure accelerated through thin liquidity. No conspiracy required, just mechanical market dynamics doing what they do. Scenario 2. Coordinated intervention. The halt occurred at the precise moment silver was testing a level that would have triggered systematic short covering across concentrated positions. This is the third CME disruption affecting metals in 6 weeks, after years of clean operation. The selling after resumption was not stop-loss behavior. Stop-loss cascades are choppy. They find bids, they bounce. What happened Tuesday was immediate, linear, and sustained. Coordinated selling into a reset order book where institutional players had pre-positioned short exposure and retail was still logging back in. Richard Ney wrote in The Wall Street Jungle about how the specialists who control market infrastructure always operate with information and access that outside participants simply cannot match. When you control the mechanism of price discovery, you control price discovery itself. A well-timed halt resets momentum, clears the tape, and delivers price to wherever it needs to be, before the public even understands what happened. Here is the historical precedent that anchors everything we're discussing. March 2020. Silver was pressing toward 1890 in the early session. COMEX experienced a data feed disruption, lasting approximately 25 minutes. When the feed restored, silver was at 1640. $2.50 move, inside a window where retail couldn't react. What followed over the next 5 months was a move from 1640 to 2930. The disruption didn't cause that move. The physical supply pressure that made the disruption necessary caused that move. The halt was the symptom. The shortage was the cause. When the underlying reality couldn't be contained any further, price moved to where the physical market was already trading. Tuesday's halt fits that exact pattern. Physical leaving COMEX, Shanghai premium persisting, open interest rotating to ETFs, delivery pressure building into April, and a halt, that reset momentum, exactly when the breakout was beginning. Now, here's what could delay this. April longs could roll forward into July and September, relieving immediate delivery pressure. Shanghai premium could narrow if Chinese industrial demand softens. Mexican mine output, currently disrupted by ongoing security deterioration across Sonora and Chihuahua, could stabilize under coordinated enforcement. These are real variables. The bear case deserves honest assessment. But here's the counter. April longs rolled last cycle too, and registered inventory still declined. Shanghai premium has been above $12 for 19 consecutive sessions and is widening, not narrowing. Mexico supply disruption is escalating, not resolving. The structure that made Tuesday's halt necessary has not changed. Delivery pressure doesn't disappear because 1 month's contracts roll forward. It compounds. Bottom line, silver was trading $92.40. CME halted order routing for 40 minutes, citing technical issues. Price reopened at $89.10. That's a $3.30 drop. Inside a window retail couldn't access. COMEX registered down 3.1 million ounces in 72 hours. Total registered 83.2 million. April open interest, 6,200 contracts, representing 31 million ounces. Shanghai premium, $16.40, persistent and widening. COMEX open interest down 92 million paper ounces, while SLV absorbs physical. Third CME disruption in 6 weeks, after years of clean operation. March 2020 precedent shows a halt at resistance, followed by a 78% move when underlying delivery pressure proved real. Pull the vault reports yourself. Check the Shanghai premium. Verify the April open interest against registered inventory. The people who won't check are the ones most exposed when the resolution comes. The ones who look at the actual data don't need anyone to tell them what it means. This is financial warfare education, not investment advice. Invest with data, not with hope.